Hello guys, welcome to my YouTube channel. So today our topic is ratio analysis. Its types of accounting ratio. Okay. So there are four types of accounting ratios. First is liquidity ratio. Second one is solvency ratio. Third one is activity ratio, and fourth one is profitability ratio. Okay, so let's start with liquidity ratio. So what do you mean by liquidity ratio? Liquidity ratio is the ability of the company to meet its short-term financial obligation. That is, a company's ability to meet its short-term financial obligation. So this is the meaning of liquidity, and there are two types of liquidity ratio, that is current ratio and quick ratio. Okay, this quick ratio we will say it as liquidity ratio also. So current ratio, it shows the relationship of current asset to the current liability. Okay, CA is current asset and CL is current liability. So here, what do you mean by current asset? Current asset is an asset which can be converted into cash within 1 year. And what is current liability? It is the obligation to pay off within 1 year. Okay, so current asset, it is an asset which can be converted into cash within 1 year, and current liability, it is an obligation to pay off within 1 year. Okay, so current ratio formula is current asset divided by current liability. And what all things will be included in current asset? Current asset includes current investment plus trade receivable plus cash and bank balance, then advances, then other current asset. Okay, these things will be included in current asset. And current liability includes short-term borrowing plus trade payables plus short-term provision plus other current liability. So these things will be included in current liability. And the ideal ratio, current ratio's ideal ratio is 2:1. Okay, so next let's move on to quick ratio. It shows the relationship of quick asset with current liability. The formula is quick ratio is equal to quick asset divided by current liability. Quick asset include what all things? All the current asset except inventories and prepaid expense. So from the current asset we have to reduce the inventories and prepaid expense, then you will get quick assets. Current liability, same thing, that is short term borrowing, trade payable, short term provision, other current liability. And what is the ideal ratio? 1:1. You can write this in the difference. If difference between current ratio and quick ratio is asked, then you can write it is a quick current asset is the shows a relationship of the current asset to the current liability, and quick ratio is the shows a relationship of quick asset with the current liability. And you can write the formula of this. Then you can write this ideal ratio, that is 2:1, and in quick ratio is 1:1. Okay, then next, second is a solvency ratio. Solvency ratio, it is an ability of a company to meet its long-term indebtedness. Okay, so this liquidity ratio, it is for the short term period, and solvency ratio is ability of the company to meet its long term indebtedness, and liquid ratio, it is to meet its short term obligations. Okay, indebtedness can be also called long term obligation. Okay, under solvency ratio there are 5 ratios. First one is debt to equity ratio. Second one is proprietary ratio. Third one is debt to total asset ratio, and fourth one is interest coverage ratio. Okay, so first let's do this debt to equity ratio. Debt to equity ratio shows the relationship between debt and equity. So the formula is debt to equity ratio is equal to long term debt divided by equity or shareholders fund. This is the formula of debt to equity ratio. This long term debt includes long term borrowing plus long term provision. Okay, so debt to equity ratio, it shows a relationship between the debt and equity. Therefore the formula is long term debt divided by equity or shareholders fund. Long term debt includes long term borrowings and long term provision, and shareholders fund includes share capital and reserves and surplus. Okay, then next move on to proprietary ratio. It shows the relationship between proprietors fund and total asset. Therefore, the formula is shareholders fund or equity divided by total asset. Here shareholders fund includes the same thing, that is share capital and reserves and surplus. Then total asset includes non-current asset and current asset. Okay. So next is debt to total asset ratio. It shows a relationship between the debt and total asset. Therefore, the formula is debt divided by total asset. Okay, so we know what is included in debt, that is long-term borrowings and long-term provision, and total asset includes the non-current assets and current asset. Okay. Next is interest coverage ratio. It shows a relationship between net profit before interest and tax on long-term debt. So the formula is net profit before, it is very important, you have to calculate the net profit before interest and tax. If the net profit after tax, interest and tax is given, then you have to reduce the interest and tax divided by interest on long-term borrowings. Okay, so this is the formula for interest rate coverage ratio. Next, we have finished the solvency ratio. Next is activity ratio. So what do we mean by activity ratio? It measures how well the resources of the company have been used in the business. So what do you mean by activity ratio? Activity ratio measures the how well the resources of the company have been used in the business. So how the resources are being used in the business, they will measure that. Activity ratio will measure that. So and the result should be written in terms of number of times. Okay. Number of times. So under activity ratio, there are 4 types of ratios. First one is trade receivable ratio. Second is trade payable ratio. Fourth one is working capital ratio, and the fourth one is inventory turnover ratio. Okay, so firstly, trade receivable ratio. This ratio established the relationship between the credit revenue from operation and average trade receivable. So it is a relationship between the credit revenue from operation and average receivable. So what is the formula? The formula is credit revenue from operation divided by average trade receivable. So this average trade receivable, average means opening balance plus closing balance divided by 2. This is the average. How we calculate the average? We calculate the average plus average by adding the opening balance and the closing balance, then divided by 2. Okay. Then trade receivable, there are 2 types: debtors and bill receivable. So in the question, if both are given, then you have to calculate the trade receivable like if we say 100 plus bill receivable is also 100. This is opening balance and closing balance 150 plus closing balance 150 plus 150. Okay. So how we will calculate the average? We will calculate the average by calculating the opening balance of debtors and bill receivable, that is 200, and the closing balance of debtors and it is 300, then divided by 2. 500 divided by 2. Like this you have to calculate the average trade receivable. Then credit revenue from operation. What is the formula for calculating the credit revenue from operation? The formula is total revenue from operation minus cash revenue from operation. Always you have to keep in mind that total revenue from operation is equal to credit plus cash. So what will be the credit revenue from operation? It will be total revenue from operation minus cash revenue from operation. And what is cash revenue? That is total minus credit. Okay. Then next we can move on to the trade payable ratio. It shows the relationship between net credit purchase and average trade payable. So what is the formula? Formula is net credit purchase divided by average of trade payable. Here also here it is trade payable, so it will be creditors and bill payable. So the same method, opening and closing, average of that we have to take. Then net credit purchase. The formula is, to calculate net credit purchase, total purchase minus cash purchase minus purchase return. Here also you have to keep one thing in mind, that total, how we will calculate the total purchase? cash purchase plus credit purchase plus if there is any purchase return, then we will add that also. Okay, so how you will calculate the credit is equal to total purchase minus cash minus purchase return. Okay, so we have completed trade payable ratio also. Next is working capital ratio. Working capital ratio shows the relationship between working capital and revenue from operation. So what is the formula for this? The formula is revenue from operation divided by working capital. Working capital formula is current asset minus current liability, and revenue from operation formula is total sales minus sales return. Okay, working capital ratio shows how effectively working capital has been utilized. Okay, next is inventory turnover ratio. It shows the relationship between the cost of revenue from operation and average inventory. Okay, so the formula is cost of revenue from operation, or we can say it as cost of goods sold divided by average of inventory. Okay, so cost of revenue from operation, or we can say it as cost of goods sold. How to identify that? Opening inventory plus net purchase plus direct expense minus closing inventory, or one more formula is there, revenue from operation minus gross profit. Okay, so there are two formula to calculate the cost of goods sold or cost of revenue from operation. So first formula is this is in terms of inventory. So we have to take opening inventory, then reduce the closing inventory, then add the net purchase, then add the direct expense, then you will get the cost of revenue from operation or cost of goods sold. Then another formula is we have to reduce the gross profit from the revenue from operation. So in short, this inventory turnover ratio shows that the number of times amount invested in inventory is used in converting into revenue from operation. So this is the meaning of inventory turnover ratio, that is, it shows the number of times the amount invested in the inventory is used in converting into revenue from operation. So this is all about activity ratio. Next ratio is profitability ratio. So what do you mean by profitability ratio? It measures the efficiency of business. Okay, profitability ratio measures the efficiency of the business. Under this, there are 5 ratios. First ratio is gross profit ratio. Second ratio is net profit ratio. Third ratio is operating ratio, and fourth ratio is operating profit ratio. Fifth is return on investment or return on capital employed. Okay, so let's start with gross profit ratio. Gross profit ratio shows the relationship between gross profit with revenue from operation. Therefore, the formula is gross profit divided by revenue from operation into 100. This is the formula. So here gross profit is equal to revenue from operation minus cost of revenue from operation, or we can say is that cost of goods sold. Okay, then net profit is a relationship between net profit and revenue from operation. So the formula is net profit divided by revenue from operation into 100. So how to calculate the net profit? Net profit is equal to gross profit plus other income minus indirect expense minus tax, or we have another formula, revenue from operation minus cost of revenue from operation minus operating expense minus non-operating expense plus non-operating income minus tax. Okay, so there are two formula to calculate the net profit. First formula is gross profit plus any other type of income, then reduce the indirect tax and indirect expense and tax. Next is revenue from operation. From that, reduce the cost of the revenue from operation, then reduce the operating expense, non-operating expense, then add the non-operating income. Non-operating income only you have to add here, then reduce the tax. Okay, so next is operating ratio. We will see operating ratio. It is a relationship, shows the relationship between, so in terms of operating ratio, what will be there? Operating between the operating cost and revenue from operation. Therefore, the formula is operating cost divided by revenue from operation into 100. Okay, so how to calculate this? So this is the formula. Then another formula is also there, that is cost of goods sold plus operating expense divided by revenue from operation multiplied by 100. So if it is directly given operating cost, then you can write the amount. If operating cost is not given, then you have to calculate the cost of goods sold and add with the operating expense, then divided by revenue from operation. Next one is operating profit. It shows the relationship between operating profit and revenue from operation. Okay, so the formula is net operating profit divided by revenue from operation into 100. So how to calculate this net operating profit? It is equal to net profit after tax plus non-operating expense minus non-operating income, or another formula is there, that is gross profit minus operating expense plus operating income minus tax. So here now when you calculate the net operating profit, there are two types of ways which you can calculate the net operating profit. Okay, one way is that you can use the net operating profit or gross profit. If you are using the net profit, if you are using the net profit, then you should take it after tax, then you should add the non-operating expense, then reduce the non-operating income. If you are taking the gross profit, everything operating you have to take, that is you have to reduce the operating expense and add the operating income, then reduce the tax. Okay, next is return on capital employed or return on investment. Okay, so return on capital investment, it shows the relationship of profit before interest and tax with capital employed. Therefore, formula is net profit before interest and tax divided by capital employed. Okay, so how to calculate this capital employed? There are two methods of calculating it. One is asset side approach and the other is liability side approach. So if whichever method you do, asset side or liability side, the answer will be same. Okay, so let's See how you will calculate this capital employed using the asset side approach. Fixed asset plus non-current investment plus the working capital. So how to calculate this working capital? It is current asset minus current liability. If working capital is not given, you can use this formula, current asset minus current liability. You can add this current asset and reduce this current liability. Then if you use the current liability, if you use this liability side approach, then you have to take share capital, then add the reserves and surplus, then add long term borrowing. Okay, so from this you will get the liability side approach, but the answer for asset side and liability side will be same. In the question you have to read carefully. Whichever information is provided, you have to take appropriately. Like if it is given fixed asset, current investment and all, for confusion they might give share capital, but there won't be resource and surplus, long term borrowing. So you should take the asset side approach, and that fixed asset, then add the non-current investment, then working capital. If working capital is not given, then the current asset minus current liability should be taken. Okay, the liability side, it is share capital plus reserves and surplus plus long term borrowings. So we have completed the profitability ratio also. So I hope everyone understood this ratio analysis topic, and I will be covering few questions related to these ratios, which will help you to understand these topics in a better way. Okay, so stay tuned for my next video. If you liked my video, please like, share and subscribe to my YouTube channel. Bye bye.